we've also been talking to a lot of our public clients about further ways to re-optimize the fixed income portfolio given this new reality. The treasury rates exceptionally low. Where else can you look for growth? Does that mean going globally, potentially? Does it mean looking for more opportunistic investments that are created by this market volatility? We think there is area you can do there as well. So the message isn't completely bleak, but it is causing everyone to rethink how they're going to approach fixed income and their overall asset allocation as well. We'd be happy to address any questions.
Just throw out to you, your current portfolio index is yielding around 3%. Your portfolio is, we would estimate it as a yield of closer to 4%. And if we're right that some of the corporate bonds and other that might be trading at a discount to face value, so long as those pay off, as we believe they will, you actually could get a return of closer to 5%. But to be getting more than that out of bonds, you need to be thinking about strategic allocations to things like more emerging market debt, possibly at an appropriate time, more high yield, looking if there's other things like this TELF investment that was successful for you, that could be making sense. There's different equity strategies that I'm sure Lori and team and your consultants are talking to you about. So there's a lot of ways to still get there. It would be easier if we were all looking at 8% yields, but it's an interesting world. I think we would say I would be a little cautious. We are certainly not taking extra credit risk in your portfolios right now, even though some things have, for the most part, it's treasuries have rallied and the rest of the bond market sort of stayed put, and equity markets have sold off. But they've sold off because we have lower growth expectations for the global economy, and that isn't quite fixed yet. So I just say, be a little bit patient. You might be able to invest at lower prices.
Is there any questions we can answer?
Are any of your clients going to requesting a mandate change or from core to core plus?
Absolutely. We've seen a big migration to core plus, and I'd say our clients are actually now looking to even go beyond that. And there's two main areas that our clients have been looking towards.
So core plus would be sectors like high yield emerging markets, non-U.S. developed bonds like Germany, Australia, Canada, adding some potentially currency exposure within a portfolio. And I think our clients are even moving beyond that. So they're saying, does it still make sense to have most of our exposure within the U.S. or should we look more globally? That's one area of interest we've seen is global diversification, and the other is more, interest rate flexibility. So right now, with interest rates essentially at zero in the short term, it's pretty clear that the future path of interest rates will be higher. And for most bond investments, rising interest rates is not a positive. So how do we reorient our portfolio given that reality that rates will likely be rising in the future? So those are two main strategies we're talking about. Did I answer your question? Yeah.
One other thing I'll throw out just to put some jargon out there, but another thing that people are being slow to implement, but those who have been very happy, is a concept called tail risk hedging. We use it in some of our portfolios where we're managing multiple asset classes. So what it means to do is almost like buying, it's not the same as the old concept portfolio insurance, but it's buying options to protect the downside of your portfolio in a really what we call a tail event of declining equity markets. And what some people have decided to do is, to the extent they feel that their portfolio can't decline by more than 15%, they're more comfortable taking more investments in higher expected return, but more volatile assets. So the two can no one really just wants to pay insurance if they think they're not going to have an accident, because it reduces your return. But if simultaneously it lets you invest in some higher returning things, or particularly if when the markets are going down, if you're getting a bunch of insurance, but if you're getting payoffs from the insurance at the same time that the markets are down, it allows people to be more offensive in their investing. And clearly, the people who we've had that have had those have been some of our happier clients recently.
Do you have questions, Mark?
Oh, just a year from now, do you expect your government allocation to be lower than what it is today?
It's an interesting question because I think there's multiple decision nodes, and if the current trajectory, the way that markets are trending right now, I'd expect to have a continued higher allocation to government securities. That being said, if we do see growth somewhat resume in the second half of the year, we see some policy measures be put in place either on the monetary policy side, or if President Obama can get some kind of fiscal stimulus passed, we do think there could be a resumption to growth and flight towards more risk assets. So
I would just say, like, this month, we actually bought more U.S. Treasury bonds. This is a little bit more of a defensive strategy. We know we're not going to help you pay your liabilities if we stay in those for the next 5 years. So we're going to be looking for sort of the responsible time to be selling treasuries and buying higher returning assets. But we wish we'd owned more of them, to be honest, the last 3 weeks.
Don't have any further questions? Thank you very much. We appreciate your presentation.
thank you.
Thanks for your time.
Thank you, Candace.